There's something I've realized after years of watching the financial markets. Most investors don't actually lack opportunities. What they lack is a strategy that fits the way they want to live. You can find thousands of stocks in the market, hundreds of ETFs, dividend income strategies, bonds, real estate, covered calls, and countless other financial products. But the more choices we have, the more important one question becomes. How can you generate income from your investment portfolio without giving up too much of its future growth potential? This is an especially important question for people approaching retirement, or for those who are already retired and want their portfolio to generate a steady stream of cash flow each month. Because when you're younger, it's easy to say, I just need growth. You can tolerate volatility. You can wait 10, 20, or even 30 years for your assets to grow. But once you start relying on your portfolio to help pay for your lifestyle, the story changes. Income becomes important. But there's a trap that many investors overlook. A high income yield does not necessarily mean a high return. An investment might pay you 8%, 10%, or even 12% a year. But if the underlying asset keeps losing value, you may not actually be getting richer. And that's exactly why I want to talk about a rather interesting strategy that many investors may have never heard of. It's CBCC, the Mulvihill Canadian Bank Enhanced Yield ETF, an ETF focused on 6 of Canada's largest banks. Now, if you're hearing this and thinking, wait a minute, why are we talking about Canadian banks? I understand the question, but what makes this interesting isn't simply the 6 banks themselves. What really stands out is the way CBCC attempts to combine growth, dividends, leverage, and options to generate income. And in my view, that's where the story gets really interesting. Imagine owning a group of large established bank stocks, businesses that have survived multiple economic cycles, financial crises, and periods of significant market volatility. Normally, if you wanted to increase the income generated by a portfolio like this, you might use a covered call strategy. You own the stocks and sell call options against them in exchange for option premiums. Sounds great. You own the stocks and you collect additional income. But there's a catch. If the stocks rise sharply, the options you sold can limit some of the upside you get to participate in. And this is one of the most important lessons in investing. There is no such thing as completely free income. If a strategy generates additional income, you are almost certainly giving something up on the other side. It could be liquidity, it could be additional risk, it could be growth potential, or in the case of covered calls, it could be some of the upside of the underlying asset. CBCC is structured somewhat differently. According to the structure presented in the video, the fund uses approximately 25% leverage and primarily implements its option strategy on that leverage portion of the portfolio. Put simply, imagine you have $100. The core capital remains exposed to the 6 major Canadian banks. Then roughly $25 of leverage is used to expand the position, and this is also the portion where the option strategy is implemented. That creates a rather interesting structure. Instead of aggressively selling covered calls across the entire portfolio, the strategy attempts to generate additional income from the leverage portion while preserving the upside potential of the core capital. And that's exactly what makes CBCC worth paying attention to. According to the data presented in the video, the fund's distribution in 2026 is approximately 9 cents per month, or about $1.08 per year per unit. Based on the NAV mentioned in the video, that translates to a yield of roughly 8%. An 8% yield certainly sounds attractive. But I want you to pause here for a moment. Don't focus only on that 8% number, because a smart investor doesn't just ask, how much money am I getting every month? They also ask, after all that income, how much has my actual wealth increased? That's the difference between chasing yield and focusing on total return. And that question brings us to the most interesting part of this story. Can a high-income strategy like CBCC actually help investors make more money over the long term? Or is that 8% yield simply an attractive number on a fact sheet? To answer that question, we need to take a deeper look at how CBCC works, how it compares with other popular bank ETFs, and most importantly, can combining income with growth actually create an advantage for long-term investors? If you've made it this far, I want us to set aside that 8% yield for a few minutes, because that number can be very tempting. In investing, big numbers have a strange way of grabbing our attention. An ETF paying 4% might seem fairly ordinary. An ETF paying 6% starts to get our attention. But when we see a yield of around 8%, a lot of people immediately think, this is exactly what I've been looking for. I understand that feeling. But after years of watching how people manage their money, I've realized that the most important question isn't how much an investment pays you. It's this: where is that money coming from? And what are you giving up to receive it? And this is where CBCC gets interesting. Let's go back to the traditional covered call strategy. Suppose you own $100 worth of bank stocks. You sell a call option in exchange for an option premium. If the stock doesn't rise too much, you can keep the premium and continue owning the shares. Everything sounds great, but if the stock rises sharply above the strike price, your upside may be limited. And that isn't a flaw in covered calls. That's simply how the strategy works. You're exchanging some of your future upside potential for income today. Sometimes that's a perfectly reasonable trade-off, especially for someone who is already retired and prioritizes steady cash flow over maximizing growth. But the problem appears when the underlying asset enters a period of strong growth. Imagine a bank stock rises 20% one year. If you own the stock directly, you have the opportunity to capture almost all of that gain. But if you've sold a call option at a lower strike price, some of that upside may be left on the table. You collect the premium, but you give up some of the growth. That's why I always tell investors, income and growth don't always naturally go hand in hand. Sometimes you have to make a choice. And this is where CBCC attempts to do things differently. According to the structure presented, CBCC uses approximately 25% leverage. That means the fund isn't relying solely on the original $100 of capital. It expands its exposure to the group of banks through the leverage portion. But what matters even more is how the options are used. Instead of applying the option strategy across the entire core portfolio, the fund focuses its option writing on the leverage portion. You can think of it like a car. The original $100 of capital is the main engine. The leverage is like a turbocharger. And the option strategy is a tool designed to generate additional income from that added exposure. If this structure works as intended, investors may be able to continue participating in the upside of the bank stocks while also generating additional income from option premiums. Of course, I want to emphasize one thing. Leverage is not free money. Leverage can amplify returns when the market moves in your favor, but it can also make losses more severe when the market moves against you. That's why you should never evaluate a leveraged ETF based on yield alone. You need to consider volatility, portfolio structure, fees, interest costs, and your own ability to tolerate risk. This is a principle I think many investors overlook. They look at the monthly income, but they don't look at where that income is coming from. They see 8%, but they don't ask, where is this 8% coming from? Dividends, option premiums, leverage, or some combination of all three. With CBCC, the answer is a combination. Part of the income comes from dividends generated by the 6 banks. Another part is enhanced through the option strategy applied to the leverage portion. That's why the yield can potentially be higher than simply owning the 6 banks directly. But now we come to an even more important question. Is CBCC actually better than simply owning the 6 banks? This is where we need to look at total return. Because if an ETF pays you a large amount of money every month, but the value of the underlying investment declines by a similar amount, you aren't necessarily building more wealth. Imagine you invest $100,000. After 1 year, you receive $8,000 in distributions. Sounds great. But if the value of the portfolio falls by $7,000, the picture looks very different. You can't simply look at the $8,000 you received and conclude that you earned 8%. That's why total return matters. Total return attempts to answer a much simpler question. After accounting for both income and changes in the value of the investment, how much wealth has the investor actually gained? And according to the data presented in the video, this is what makes CBCC particularly interesting. During the periods compared, CBCC not only outperformed some other bank-covered call ETFs, such as ZWB and BKCL. The video also shows CBCC outperforming ZEB, a simpler ETF focused on holding the 6 major Canadian banks without using covered calls in the same way. If that performance continues over the long term, it would certainly be worth paying attention to, because it raises an interesting question. If traditional covered calls typically trade some upside for income, could a structure that uses options primarily on the leveraged portion create a better balance? That is the central idea behind CBCC. Not that it has no risk, not that an 8% yield is guaranteed, and certainly not that CBCC will always outperform. Rather, its structure is designed to address a very practical problem for income investors. You want cash flow today, but you also need your assets to keep growing tomorrow. This is particularly important for people who are already retired. Suppose you have $500,000 invested in your portfolio. You need $30,000 a year to help support your lifestyle. You're not only concerned about whether the portfolio can generate that $30,000, you also have to think about how much capital will be left after 10 or 20 years, because time can be an investor's greatest friend, but it can also become an enemy if you continually withdraw money from a portfolio that isn't growing fast enough. That's why I think the concept of income plus growth is worth considering. Not income alone, not growth alone, but finding a balance that fits your financial goals. Now let's look at some alternatives. ZWB is an easy example to understand. It also focuses on the 6 major Canadian banks and uses covered calls to generate income. Its strength is its simpler structure. It doesn't use the 25% leverage that CBCC does, but because of that, its yield is also significantly lower, according to the data presented in the video. Then there's BKCL, which takes a different approach. It also uses approximately 25% leverage, but the covered call strategy is applied across a larger portion of the portfolio. That can potentially generate more option income, but it also means investors may give up more upside when the bank stocks rise sharply. And then we have newer strategies, such as SIXC, with higher leverage and a more aggressive option strategy. You start to see a very clear picture. A higher yield does not necessarily mean a better strategy. Sometimes a higher yield simply means you're accepting more risk. Sometimes you're giving up more upside. And sometimes you're using more leverage. So instead of asking, which ETF pays the most, I think investors should ask, which ETF best fits my financial goals, risk tolerance, and investment time horizon? That's a more mature question. And it's also how long-term investors tend to think. There's another thing I want you to keep in mind. Past performance does not guarantee future results. Canadian banks may continue to perform well, but no one can guarantee that. Interest rates can change. The economy can enter a recession. Credit quality can deteriorate. Bank profit margins can come under pressure. And during a major market decline, leverage can make volatility even more significant. So I would never call CBCC a safe investment simply because it owns large established banks. It's still a financial product with a more complex structure than simply buying bank stocks directly. But that complexity is also what makes it worth studying. Because sometimes a good investment strategy isn't the strategy with the most features. It's the strategy that solves the right problem. And with CBCC, that problem is very clear. How can you turn a portfolio of bank stocks with growth potential into a stronger source of income while still trying to preserve long-term upside? That's the question CBCC is attempting to answer. And if you're an income-focused investor, it may be a question worth spending some time thinking about. Because ultimately, investing isn't just about how much money you can make. It's also about what you want your money to do for your life. After everything we've just discussed, I think the most important question isn't whether you should buy CBCC, because I don't know your financial situation. I don't know whether you're 35 or 65. I don't know whether you're building wealth for retirement, living off dividend income, or simply trying to create an additional source of income for the future. And that's exactly what I want you to remember. There is no single investment that is right for everyone. What we can do is understand how a strategy works, understand the rewards it offers, understand the price we pay for those rewards, and then decide whether it actually fits our lives. CBCC is a very interesting example of how modern financial markets continue to search for a balance between two needs that can sometimes seem contradictory. On one side, there's income. On the other side, there's growth. You want your portfolio to pay you today, but you also want that capital to continue growing for tomorrow. And if you've managed money for a long time, you know that this isn't a simple problem to solve. Think about someone who is 60 years old and approaching retirement. They may no longer want to put all of their assets into highly volatile growth stocks, but they also don't want all of their money sitting in investments with little to no growth potential. They need cash flow, but they also need to protect their purchasing power against inflation. They need stability, but they also need growth. That's why income-generating strategies can be so appealing. But I want to emphasize this one more time. Yield is not the whole story. An 8% yield does not automatically make an investment a good investment. You have to look at total return. You have to look at volatility. You have to look at leverage. You have to understand how the options are being used. And most importantly, you have to know what you can tolerate when the market moves against you. Because it's very easy to love an investment strategy when the market is going up. Everything looks smart when stock prices are rising. But the true nature of a strategy is revealed when the market gets difficult. That's when leverage becomes important. That's when the option strategy gets tested. And that's also when an investor's psychology gets tested. And I think this is one of the biggest lessons in investing. You don't need a perfect strategy. You need a strategy you can actually stick with. A strategy that looks great on paper, but causes you to panic and sell when the market falls 20% may not be a good strategy for you. On the other hand, a strategy that fits your goals, time horizon, and risk tolerance can help you sleep better during periods of market volatility. That is the real value of understanding an investment before putting your money into it. And CBCC gives us a very important lesson to think about. It shows us that in the modern investment world, you don't necessarily have to choose completely between income and growth. There are strategies that attempt to combine both, but every combination comes with trade-offs. CBCC uses leverage. CBCC uses options. CBCC depends on the performance of a group of Canadian banks. And because of that, it isn't as simple as simply buying and holding a group of stocks. But that's also why understanding its structure matters. If you understand how it works, you have a much clearer idea of what you actually own. And this is something I always want people to remember when they enter the financial markets. Don't buy an investment simply because it pays you a lot of money. Buy it when you understand why it pays you that money. If the income comes from dividends, understand how the underlying businesses generate those dividends. If the income comes from options, understand how the option strategy works. If the income is supported by leverage, understand what happens when the market falls. And if an investment has an unusually high yield, always ask yourself, what am I being paid to do? It may be one of the simplest questions in investing, but it's also one of the most important. Because the market rarely gives you a high return without requiring you to accept some form of risk in exchange. CBCC is a clear example of that. According to the data presented in the video, the strategy has produced notable results during the periods that were compared. It suggests that using covered calls on a limited portion of the portfolio, combined with leverage, can create a structure that is different from traditional covered call ETFs. But remember, the past is data, not a promise. No one knows exactly how CBCC will perform over the next 5, 10, or 20 years. No one knows what economic cycles Canadian banks will go through, and no one can predict the market with certainty. That's why I don't want to end this video by saying, you should buy CBCC. I want to end with a different question. How do you want your investment portfolio to serve your life? Do you want to maximize growth? Do you want to generate income? Do you want to balance both? Or do you want a simpler strategy that is easier to understand and uses less leverage? The answer will be different for everyone. And that's both the beauty and the challenge of investing. There is no single path to financial freedom. Some people build wealth through real estate. Some choose index funds. Some focus on dividend stocks. Some prefer bonds. And others use option strategies to generate income. What matters isn't which path you choose. What matters is that you understand the path you're on. Because money isn't just a number on a screen. Money is time. Money is freedom. It's the ability to say no to a job you no longer want. It's the ability to spend more time with your family. And for many people, that is the ultimate goal of investing. Not becoming the richest person in the room, but having enough assets so that your life is no longer completely dependent on a paycheck. So if you're building an income-focused portfolio, remember 3 things. Don't just look at yield. Look at total return. Don't just look at potential returns. Look at risk and leverage. And finally, don't ask, is this the best investment in the market? Ask, is this investment right for me? That is the difference between chasing an attractive investment and actually building a financial plan. CBCC may be a strategy worth researching for investors who want to combine income and growth through exposure to Canadian banks. But do your homework. Read the fund documents. understand the options, understand the leverage, and evaluate it in the context of your entire portfolio. And if you've ever invested in CBCC, ZWB, ZEB, or a similar income-focused ETF, I'd love to hear about your experience. Would you prioritize an 8% income yield, or would you prefer a simpler strategy with less leverage? Share your thoughts in the comments below. Because sometimes, one of the best ways to understand the market isn't simply by listening to one person. It's by hearing how other investors are thinking. If you found this video helpful, hit the like button, subscribe to the channel, and turn on notifications. We'll continue exploring investment strategies, passive income opportunities, and the stories behind the numbers that many investors overlook. And remember, building wealth isn't a sprint, it's a long journey. And sometimes, the best financial decision isn't the one that makes you rich the fastest. It's the one that helps you stay on the right path for many years without losing your peace of mind. I'll see you in the next video.